everyone. Today we are going to discuss about liquidity concept. It's the most important concept to learn in order to understand how the price moves and how the manipulations are done by big banks. According to web theoretical definition, liquidity refers to the efficiency or ease with which an asset or security can be converted into ready cash without affecting its market price. In every financial market, we should know that for every buyer, we need the seller, and every transaction is made with artificial intelligence. Big banks and institutions are the market makers. They move the market impulsively with buy and sell orders. If you think that small traders change the price course, then you are so wrong. As I just mentioned before, the functioning of any financial market requires two parts: the buyer and the seller. So you figure out that you are dealing with big banks and that your money lost in trading will go straight into the pocket of another winning trader. The most common strategies of trading rely on indicators, technical analysis, and chartist figures. Have you ever wondered about the reliability of what you have learned from the net, whether ebooks or on social networks? The majority of traders use the same methods and look to the chart from a retail logic, and unfortunately more than 90% of them can't make good results. You'll notice that these traders that use retail methods spent many years struggling in trading and still can't be profitable. Let's take a look to some examples and see what decision you will take in each situation. Now we have 5-minute Nasdaq chart, and we are at the level of a small range, as you can see. We have a bearish breakout with a big red candle and also a retest of the support area with the wicks of these 2 or 3 candles. Probably you were going to take a short position here with a stop loss above the breakout. So let's see what will happen. Unfortunately, you got stopped. Just after that, we have a bullish breakout with a big green candle and a retest of this resistance line. Probably you were going to take a long position here with a stop loss below the resistance. So let's see again what will happen. And you got stopped again. This is not a fake out or an indecision in the market. This is the manipulation made by big banks and institutions. They have created this range in purpose to induce in error retail traders, take their stop losses, and then move the price to its final direction. What I wanted you to know is that if 90% of the traders are using these methods, then the algorithm of trading programmed by big banks will be able to recognize some levels of price that have a bunch of stop losses. Liquid areas occur essentially where people are placing the stop losses or where pending orders are being set. These stop losses form the liquidity of the market, which will serve as a fuel for the market makers. Let's move on now to types of liquidity. So we have 2 types: visible liquidity and hidden liquidity. Visible liquidity occurs essentially at the level of supports, resistances, double tops, and double bottoms. Hidden liquidity occurs essentially at the level of trend lines, swing lows, and swing highs. In this chart, we have a clear support area that has been tested for more than 4 times, made this fake bearish breakout, took the liquidity once and tapped into the support line after that to accumulate long positions from retail traders, and then dropped down after all these consecutive manipulations. All retail traders recognize this figure, right? This is a descending channel. Books will probably recommend to take a long position once a green candle breaks above this channel. So let's see the manipulation happening here. Just after dropping to the low of this channel, we have green candles as a sign of reversal created by big banks. Retail traders will probably think about taking a long position here, but unfortunately, they'll be out again. Again, we have liquidity sitting above these equal highs or resistance as retailers like to call. Once you spot these 3 down candles, you're probably going to take a short position and set the stop loss just above the resistance. The price after that will change the direction, trade higher and hit your stop loss. Let's move on now to the hidden liquidity and see some examples. Most retail traders will take long positions every time that price reaches this bullish trend line and setting stop losses below these lows. This trend line was created on purpose by market makers. They already know where liquidity occurs. So the market makers will sell a large size of orders to drop the price rapidly in order to take all retail liquidity sitting there. Liquidity is also sitting on every single high and low. Why for a bullish trend we have liquidity sitting on every single low? Because there are breakout traders expecting a bullish breakout to happen and putting stop loss just below the old low. So sometimes what happens is, say for example, institutions are creating this move. If they don't have enough liquidity to continue their move, they will push price down, grab that liquidity and go upper. The swing highs and lows are considered as high liquidity levels because when retail traders will take long trades, they look for the closest swing low to put their stop loss below it, and for the closest swing high when they are taking short entries. The entry bank algorithm will detect these high liquidity swing highs and lows. You'll notice that when the price is bearish, it will target all the swing lows formed before until reaching the last one. After taking the liquidity below the last swing low, the price will reverse looking for liquidity at the level of the previous swing highs and so on. Note that at the level of swing lows, equal lows and bullish trend lines, there is sell-side liquidity sitting there. Because when retail traders will take long trades at the levels mentioned before, they will put sell stops below the equal lows or the swing low. Same thing for the equal highs, swing highs, and bearish trend lines. Retail traders will take short trades at these levels and put buy stops above them. So liquidity sitting at the levels mentioned before is called buy-side liquidity. The price will always try to create sell-side liquidity. Trade higher looking for buy-side liquidity. Once the buy-side liquidity is grabbed, the price will reverse, trade lower looking for the sell-side liquidity it formed previously, and this is how the price moves every day.